The truth about property taxes, where your money really goes, and why so many people get it wrong. Have you ever heard someone say, if I pay off my house, why do I still have to pay property taxes? Or maybe you've heard someone claim, property taxes are just paying rent to the government. These statements spread quickly on social media, but how much of them is actually true? Today we're going to separate facts from opinions. My goal isn't to tell you whether you should like property taxes or dislike them. My goal is to help you understand them, because once you understand how property taxes actually work, you'll be able to make better financial decisions, budget more effectively, and avoid some expensive surprises. Welcome to Money Smart Basics. My name is Alphonso, and this channel is all about helping everyday people build financial confidence, one smart decision at a time. If you're a homeowner planning to buy a home or approaching retirement, this video could save you thousands of dollars over your lifetime. Let's begin. One of the biggest misconceptions is that property taxes mean you don't actually own your home. Think about that for a moment. When you purchase a home, what exactly are you buying? You're purchasing ownership of the property, but every local government has the authority to tax real estate located within its boundaries. That's similar to how states collect income taxes or how governments collect sales taxes. Whether someone agrees with that policy is a political discussion. Understanding how it works is a financial discussion. Those are two different conversations. So what exactly is a property tax? Property tax is a local tax based primarily on the assessed value of your real estate. Notice I said assessed value, not necessarily what your home would sell for tomorrow. Every county or local jurisdiction has an assessment process designed to estimate the taxable value of homes. That assessed value is then multiplied by the local tax rate to determine your annual property tax bill. Many people think the government simply picks a number out of thin air. In reality, assessors usually look at factors such as recent home sales, square footage, lot size, neighborhood values, home improvements, construction quality, age of the home. This doesn't mean assessments are always perfect. In fact, they sometimes contain mistakes. We'll discuss that later because it could save you real money. Let's answer another important question. Where does your property tax money actually go? Many people believe it simply disappears into some giant government account. The truth is much different. Property taxes primarily fund local services. These include public schools, police departments, fire departments, road maintenance, snow removal in northern states, libraries, public parks, emergency medical services, trash collection in some communities, street lighting, local government operations. Think about your own neighborhood. Who repairs potholes? Who responds when someone calls 911? Who keeps local parks maintained? Who funds many of the public schools? A large portion of that funding comes from property taxes. You may not agree with every spending decision, but understanding where the money goes helps explain why property taxes exist. Now here's something many first-time homebuyers don't realize. Most homeowners don't actually write one large property tax check every year. Instead, many pay through what's called escrow. Let's say your annual property taxes are $3,600. Rather than paying one lump sum, your mortgage company may collect approximately $300 every month. That money is held in an escrow account. When the tax bill comes due, the lender pays the county on your behalf. This is why your monthly mortgage payment often includes principal, interest, property taxes, homeowners insurance. Many people believe their mortgage payment is fixed forever. Then one year it suddenly increases. Why? Often it's because property taxes increased, not because the mortgage changed. Understanding escrow helps explain why monthly housing costs can rise, even when your interest rate stays exactly the same. Here's another area that causes confusion: market value versus assessed value. Imagine your neighbor sells their home for $450,000. Does that automatically mean your house is worth $450,000? Not necessarily. Now imagine the county assesses your home at $410,000. Those two numbers may be different. Market value reflects what buyers are willing to pay. Assessed value reflects the value used for taxation. Sometimes they're close, sometimes they're very different. Knowing the difference helps homeowners understand why their tax bill may not match current housing prices. Now, let's talk about why property taxes seem to keep increasing. Have you noticed that even when politicians say tax rates didn't increase, homeowners still receive larger tax bills? How can both statements be true? Here's why. Imagine your tax rate remains exactly the same, but your home's assessed value rises from $250,000 to $350,000. Even though the rate stayed constant, you're now paying taxes on a more valuable property. That's one reason taxes increase. Another reason is that local governments occasionally vote to change tax rates. Infrastructure projects, growing school populations, new public safety expenses, debt payments. These can all influence local tax rates. Understanding the difference between rising values and rising tax rates helps explain why many homeowners feel surprised. Let's look at a real-life example. Meet James and Linda. They purchased their home 25 years ago for $180,000. Today, it's worth nearly $500,000. Sounds wonderful, doesn't it? Except they're both retired. Their mortgage is paid off. Their income is fixed. Meanwhile, their property taxes have nearly doubled over the last decade. They're not richer because they have more cash. They're richer on paper because their home appreciated. Yet their annual tax bill reflects that higher value. This is why many retirees say they feel house rich but cash poor. Understanding this issue is critical for retirement planning. Many states recognize this challenge. That's why exemptions exist. Have you ever checked whether you qualify? Some common exemptions include homestead exemptions, senior citizen exemptions, disabled homeowner exemptions, veteran exemptions, agricultural exemptions, historic property exemptions. These programs can reduce taxable value or provide direct tax relief. Unfortunately, millions of homeowners never apply simply because they don't know these programs exist. Always check with your local county assessor. You may qualify for savings. Now let's discuss something that almost nobody talks about: property tax appeals. Did you know your assessment can actually be wrong? Imagine the county records show your home has 4 bedrooms. You only have 3. Maybe they list 2,800 square feet. Your home only has 2,300. Perhaps they valued your home using larger nearby properties. These mistakes happen. Most jurisdictions have an appeal process. You'll typically gather documentation, comparable home sales, photographs, measurements, professional appraisals if necessary. If the appeal succeeds, your future tax bills could be reduced. That's money staying in your pocket year after year. Let's talk about another surprise homeowners sometimes receive: special assessments. These are different from normal property taxes. Imagine your neighborhood needs new sidewalks, water line improvements, sewer replacement, road reconstruction, street lighting upgrades. Sometimes, local governments charge nearby property owners directly for those improvements. These charges can appear separately from your annual property taxes. Many homeowners don't expect them. That's why it's important to understand the difference. Here's another common myth: I paid off my mortgage, so my housing costs are zero. Is that really true? Not exactly. Even after paying off your home, you still have ongoing ownership costs: property taxes, homeowners insurance, maintenance, repairs, utilities, landscaping, HOA fees if applicable. Owning a paid-off house dramatically lowers expenses, but it rarely eliminates them completely. That's why retirement budgets should always include these continuing costs. Let's address one of the biggest debates. Some people argue property taxes should be eliminated. Others argue they're essential. Regardless of where you stand politically, ask yourself this question: if property taxes disappeared tomorrow, how would your community replace that funding? Would local governments raise income taxes, increase sales taxes, reduce services, charge new user fees, borrow more money? There isn't a simple answer. Every funding source has trade-offs. Understanding those trade-offs helps you evaluate proposals more thoughtfully. Now, let's discuss budgeting. How should homeowners prepare? One mistake many people make is treating property taxes as a surprise. Instead, make them part of your annual financial plan. Review your assessment every year. Watch for changes. Maintain an emergency fund. Plan for increases. Review your escrow statements. Verify exemptions. These small habits prevent major financial stress later. If you're thinking about buying your first home, don't focus only on the purchase price. Ask these questions. What are the annual property taxes? How often are assessments updated? Are taxes increasing rapidly in this area? Are there special assessments planned? Do seniors receive tax relief? These questions can significantly affect affordability. Sometimes two homes with identical prices have dramatically different annual tax bills. That's something many buyers overlook. Let's look at another story. Maria found her dream home. The purchase price fit comfortably within her budget. She celebrated. She moved in. 6 months later, she received notice that the assessed value had increased after the sale. The following year, her escrow payment rose nearly $250 per month. She hadn't planned for that increase. She could still afford the home, but it required significant adjustments to her monthly budget. Had she researched the property's tax history beforehand, the increase wouldn't have come as such a surprise. Knowledge helps eliminate financial shocks. Now let's turn this into practical advice. Here's what every homeowner should do at least once a year. Review your property assessment. Compare your home's assessment with similar nearby homes. Confirm your square footage is accurate. Verify exemptions are applied. Read your escrow statement. Budget for future increases. Keep copies of tax notices. Know your appeal deadline. Simple habits like these can save thousands of dollars over time. The biggest takeaway from today's discussion is this. Property taxes are more than just another bill. They're part of the true cost of homeownership. Understanding them won't necessarily make you enjoy paying them, but it will help you avoid surprises. It will help you ask better questions. It will help you budget more effectively, and it will help you make smarter financial decisions, whether you're buying your first home or planning for retirement. Financial confidence begins with understanding how money works, not just how we wish it worked. Thank you for spending time with me today. If this video helped you better understand property taxes, please like this video, subscribe to Money Smart Basics, and share it with someone who owns a home or plans to buy one. Every week, we break down complex financial topics into simple, practical lessons you can use to build a stronger financial future. Until next time, remember, smart financial decisions don't happen by accident. They happen through knowledge, planning, and consistent action. Stay informed, stay prepared, and I'll see you in the next Money Smart Basics video. The information provided in this content is for educational and informational purposes only and should not be considered financial, legal, or tax advice. Always consult with a qualified financial advisor, tax professional, or legal counsel before making any financial decisions. The creator of this content is not responsible for any actions taken based on the information provided. Investments and financial decisions carry risk, and past performance does not guarantee future results.